Hello, and welcome back to the continuing lecture in investment analysis. Now, a question arises um, whether the portfolio manager was correct in loading up with Google over 2006 through 2010 period. Um, to do that, um, to determine that, we need to find the optimal position in Google that would have been prescribed by trainer black model. Okay. Um, but uh, we already did trainer black model in the previous chapter. So this time using uh, the weight uh, formula, right? The weighting uh, scheme that we also learned at the earlier part of the chapter 6, uh, which is equation 6.10, basically. Uh, let's find the weight of the passive portfolio and Google. And uh, using this formula, we arrive at the weight of the passive portfolio, which is like 39.11%, which makes weight of the Google to be 60.89%, and using that weight and using the risk premium, right? Using the the historical average, average excess return on the market portfolio is 0.6. So beta times that, and Google's alpha, right? And then we arrive at 1.6. Okay, with the standard deviation of 10.4. And we have the correlation coefficient between Google and the index portfolio as 0.59, and plugging in these numbers, right? Plugging in these numbers, we come to the expected excess return or risk premium on the portfolio, optimal risky portfolio, to be 1.21. Remember, this is not the return, but excess return, right? So basically, this is alpha, Google's alpha, right? And the standard deviation of our excess return is 7.69. So with this positive excess return, right, the portfolio manager would have been quite right to tilt the portfolio heavily toward Google during this period. And this reflects a large positive alpha, right? And also, it is also confirmed by the improved Sharpe ratio. So the Sharpe ratio of our portfolio, compared to the market portfolio, our Sharpe ratio is definitely higher, right? So then, what about the period beyond this 2006-2010 period? Okay, I think probably it's redundant during this period, over the sample period. I think this would be enough. Okay. So will this still, this positive alpha persist even beyond this sample period? So we took a look at, the next 6 months, next quarter, and the next 6 months, and the next 10 months, right? For S&P 500, Google, and T-bills, right? With additional 10 months, like January 2011 through October 2011, with additional 10 months. So to compare the performance to passive index and to T-bills. So then we get, for the first quarter in 2011, passive portfolio performed better. And even for the first half of the year, passive, index portfolio performed better, right? But overall, 10 months period, right? During the overall 10-month period, the proposed, optimal risky portfolio, that includes, Google, performed better, right, than the passive portfolio. Okay. So overall, we obtain the result that supports our alpha hunting strategy, or alpha hunting strategy, which may sound quite corny. I mean, this, you might say, oh, this chapter is this chapter is about capm, and obviously to the chapter would to prove the chapter will try to put forth all the evidence to justify capm. Yeah, of course, but then this is the empirical evidence. I mean, in the face of empirical evidence, there's I mean, advocating what is obviously the fact that capm is justified is kind of self-evident and self-righteous. I mean, self-righteous is rather politically incorrect word, but I mean, there's no but what I'm saying is, if you want to proof, here's the proof, right? That's what it is, and that's what it's saying. Now, so next question is, as we discussed before, computing beta from the past data will not necessarily hold for future, right? And beta changes over time because, and beta in one sample period is not necessarily the same thing as the beta in another sample period, right? Obviously, of course, because the data changes, the return changes, actual return changes, and um, so the risk premium changes. How can beta cannot be constant over a long uh, period of time. And also, another thing is mean reversion. Mean reversion is um, and I already, I believe I already mentioned this in passing in previous lectures. Um, if you have, let's suppose, Apple's, true beta, or just mean return. I mean, population, Apple's population, as I said, population data set consists of, 40 years, even if we uh, use monthly data, monthly returns, it's still 480 data points. Now, with 480 data points, right, the mean of the population of Apple would be a very neutral number. Because why? Because over 40 years, 480. I mean, the return is relatively um less. I mean, price fluctuates all the time. Price goes up. I mean, in uh, think about it. 1981, Apple was, probably a $10 stock, right? 1981. I'll have to look at the data. But over time, the price goes up, and even Apple was like $600, in 2014, I believe, and then they split. There was, a 7-to-1 split, so back to like 80 something dollars, and then even this August or September, the price was somewhere around, a $600 range, and then they $600-700 range, and they split again. I think it was like $500 range, and they split. It was like 4-to-1 split. So the price got back to like, $120 or something, right? And if you, some students may, because this, this is a pre-recorded video, and sometimes you see you're watching the video that was recorded in spring 2020, and in spring 2020, Apple was still, that was pre-split, and my, video is, my lecture is still saying uh, Apple, is, when calculating Apple's mean return, the data seems, but, obviously you would see the data, um, the time frame of the data. And, if you look back, like, 5-year time frame that started in like, January of 2016, and ending in uh, uh, January of 2020, you would, if you're looking up the data now, all the data is um, uh, uh, you know smoothed out. In other words, all the past data is recalculated uh, uh, to match current post-split price. So you wouldn't see even back in the spring of 2020, you wouldn't see Apple price being $500. You would look, if you look at it now, it is adjusted, all adjusted, right? Uh, uh, to match, current, post-split price. But, when I downloaded the data, when I got the data in like January or, March of 2020, then the data would still, in the video, would still reflect the pre-split price. But anyway, what I'm trying to say is, price fluctuates, right? And price would move from $10 back in 1981 to $600, $700, in 2019, 2020, right? Which is a huge, Apple grew almost like 9,000% or 90,000%. I can quickly but back in you can't calculate. um, I mean, using post split data, you can still you come to the same conclusion, because everything is all the past data have adjusted. But the point is, return, although prices may run from $10 to $600 range, returns do not move like that. Returns are rather pretty fluctuating, much less than the price. For example, monthly returns generally are between negative, that's reflecting the volatility, negative 20 to positive 30, or the best month for Apple within the last 5 years was when Apple monthly return was like 28%, whereas the worst month was like negative 24% or negative 20%, negative 20 or negative. But then this type of variance is relatively consistent, right? No matter what sample period you use. You understand what I'm saying? In other words, even if I take, like 1995, between 1995 and 2000 time frame, and 5-year sample, right? The month returns will not be, just because it was back in 1995, it doesn't mean the variance of the return would be negative 5 to positive 10, right? The returns would pretty much fluctuate within the like constant range. I mean, there was arithmetic average, right? Arithmetic average of look, T-bills, S&P 500, Google fluctuates a lot, but look, December of 2005, December of 2010, it's like 10-year period. It's not like this. It's not like upward trend, because it's return, right? Price would have been following that trend, right? But the arithmetic average return, being the arithmetic average, it would just fluctuate within some constant range. Of course, geometric average, even if you look at the geometric average, right, during the same period, although there is some upward trend, see, they basically fluctuate within some range, some range. Okay. So in that sense, what I'm trying to say is, in that sense, and there is, a mean reversion, because when, as you saw, if you take think about it, if you take the average of this, what would that be, right? I mean, everything, the returns basically, once it goes up, then it goes down, then goes up, goes down. I mean, if you take the mean, right? I mean, basically the mean will be a very neutral number, especially, that's why we cannot use population, because over 40 years of Apple, if you take the true mean of Apple, it will be a very, very neutral number. That doesn't give you any clue about the future, right? If you want to take advantage of the trend, or the trend dynamics of the the mean, right? Then you should take the most recent 5 years in the most recent time frame, not entire 40 years or the most remote 5 years, right? Because the first 5 years of Apple's history, right? The mean of that 5 years would be kind of may not be drastically, but would clearly be different from recent 5 years, right? Because although, I mean, this is like a 5-year sample, but over 40 years, you will have to you will see you cannot you may you cannot deny that some deterministic trend that would make the mean statistically different from mean of the most recent 5 years, statistically different from mean of the most remote 5 years, and because of that, the true mean would be a very neutral number. True mean over 40 years would be a very neutral number, right? So that because everything basically reverts back to mean. When there is upward swing, then you will see a downward swing, and that sine, cosine, it's called sinusoidal, the sinusoidal curve, right? Sinusoidal movement, sine, cosine curve would have would definitely indicate mean reversion, right? The beta. So what would be the mean reversion? Ultimately, what would be the eventual beta value, mean reverted beta value? All betas would eventually emulate, or all betas will converge to market beta. So most likely, futures beta, we have to adjust estimates from historical data to account for regression towards 1, which is the market beta. Because we are trying to forecast, future beta, and so we have to take into account that mean reversion, right? Reverting, reverting to the market beta of 1, right? So we'll have to weight, right? We'll have to allocate weight to our historical the beta that we actual beta we calculated from uh, the past data, right? And then allocate us 1 minus that weight, right, to the 1, right, beta of 1. So the common weighting scheme is usually, allocate 65% or 2/3 if beta is 0.65, right? If beta is 0.65, it's just an example. We allocate 2/3 weight on beta estimated and 1/3 on the market beta of 1. So the adjusted beta would be like 0.77, right? We can also apply that to our Google's beta of 1.2, allocate 1/3 weight to 1.2 and allocate 1/3 weight to the market beta. Yeah. But again, this is just expedient. In other words, just for convenience, right? A rule of thumb. The exact weighting scheme. There should be a better, weighting scheme. Now, final forecast beta, is in fact closer to 1 eventually, right? Than sample estimate. So alternatively, we need a better estimation model. So one of the better ways to better model for estimation is called regression, right? A better regression model is called Arch, and this is you have to take econometrics to learn all these regression techniques. Arch stands for autoregressive conditional heteroscedasticity model, right? Autoregressive means there's a autocorrelation, in a time series. You are making adjustment for that autocorrelation, and conditional heteroscedasticity. I mentioned heteroscedasticity in passing in one of the past chapters. Also, at this point, in this course, we don't go too much into the econometrics. It's a whole subject in its own right. I mean, it's a whole separate subject. It's actually if you study if you major in economics, you have to do econometrics, which is now. So to find a more accurate variance and covariance of high frequency data, usually daily. So using that data, we run Arch model or augment beta by other information such as P ratios. Okay. So that's That's how we, predict make a better, predict the future beta. But uh, normally, making adjustment using the weight like this is already, we do that because we know that the future beta will be different from uh, the beta we calculate from historical uh, data. But that is already, I mean, on a practical level, as a practitioner, making you don't even you even hardly get into uh, at adjusting for future data. Uh, Generally, even as a practitioner, you would uh, basically use the beta uh, obtained, from uh, regressing the past historical data, and a very practical level. Okay, but still, it doesn't it doesn't mitigate the importance of uh, getting a more accurate forecast for future beta using these techniques. Okay, alrighty. I guess what that's all the time we have for this segment of the lecture. So I will see you guys in the next video. Stop recording.